Let's start off with the gross income, which is up 4%. We had net income 33% stronger. Tell us about the factors that led to this performance and whether you think these numbers are sustainable given the fact that they are coming off a relatively low base.
First answer is I think they are sustainable. Second is that gross earnings doesn't take account of interest expense, and that's a line in which we had a lot of focus during this period. You'll be aware that the Nigerian market was highly liquid, and we were no different, and it did mean that rates came down very significantly, particularly in the end of the first half and the second quarter for up to June. That's allowed us to reduce our interest expense significantly and obviously gave us a net tick up, given that our margin was kept pretty stable. So that's the one aspect. The second aspect is it's a diversification of earnings for us. As you're aware, we're an investment bank as much as we are a commercial bank. And in that context, the rise in the capital markets, both by way of volume and value, has positively impacted a number of our businesses, from asset management to investor services to our corporate finance business. And so we've seen a good uptick in our fee and commission income over the period.
You're talking about diversification there, and we know that your gross loans and advances grew around 13% year on year and around 15% quarter on quarter. Tell us about the sectors that are accelerating this growth in the loans and advances division.
Lady, it's actually across a number of our factors, both in our personal business banking book as well as our corporate investment banking risk assets. It's across telecoms. We've seen a couple of very nice deals coming through in the infrastructure side and property. Our vehicle and asset finance book is growing well, alongside our unsecured loans to salaried employees. So we're seeing it pretty much across the board, which is very encouraging, I think, obviously going forward in terms of our projection for the future, particularly this year.
Profit before tax recorded a 1% drop year on year. This is despite the fact that we did see a rise in revenue. Tell us about the provisioning scenario that is playing out for your bank, and also in terms of operating costs, because that is, of course, one of the key factors when it comes to banking on the African continent.
Yeah, to answer the first question, in terms of provisioning, we haven't been heavily impacted by provisioning. You'll notice that half year we only put a further 186 million aside in terms of provision. So far the quality of our risk assets we're very comfortable with. Our results are more affected by our operating expenses, which has been a feature over the last couple of years. We're investing in the future. We're trying to build a scalable platform on which to really build a full universal bank. And we're making great strides in that respect. And during the quarter, we managed to roll out another 40 points of representation, which almost doubles the size that we were in 2007 at the time of the merger. So naturally, aligned with that, our depreciation expenses, staff expenses, and the like have increased. So for us, it's about managing the impact of that, the short-term cost increases, obviously with revenue growth, which is a key initiative amongst the bank.
In terms of your target loan book and the growth that you're expecting for this year, give us an indication of what you're planning.
Lady, from the start, we've been giving a guidance of around 20% growth in our loan book, and we stick with that as we go forward. For us, it's about leveraging off the assets that we have and the relationships that we have, and particularly getting to know customers and their needs. We're entering into new markets, we're developing new areas. Trader market is an example, and on the back of understanding of those customers and their cash flows, one can begin to think of extending credit. And certainly, as I've said, in vehicle and asset finance and many other areas, we can continue to grow. So for us, it's about very rigid risk management processes that we have, learning about this market, and they've then certainly been open for business to increase our loan book.
In December 2009, we saw a liquidity ratio of around 51.4%. It's now sitting at around 35.5%, and that was, of course, posted around June this year. Tell us about what impacted the drop in your liquidity ratio. We know that it has been mostly as a result of more profitable investment outlets. Give us some more color on this.
Yeah, I mean, the first thing is to note that obviously even at 35%, we are significantly above any required ratios for liquidity. So we remain a very liquid bank. The impact from 51 to 35 primarily is a shift out of investment securities. As I said, given the liquidity in the marketplace, what you've seen is investment securities and yields on things like treasury bills and federal government bonds have dropped significantly. In addition, if you deposit money in central bank and others, really you don't earn any kind of meaningful return at all. So the focus has been how do we find new outlets for that money, and that is in the growth in our risk assets. And that's why we have grown our risk assets, and we continue to see that as being an opportunity. So in summary, it's really just a shift out of investment securities and excess liquidity into bank to risk assets and loans to customers.